All right. So we've got a pretty packed and exciting lineup today, so I might start. Firstly, I'd like to welcome you all to today's webinar, co-hosted by the UN Global Compact Network Australia and ASFI, or the Australian Sustainable Finance Institute. My name is Kylie Porter, and I'm the Executive Director of the UN Global Compact Network Australia. Before we start, I would like to acknowledge the traditional owners of the lands that we meet upon today. For me, that's the Wurundjeri people of the Kulin Nation here in Melbourne. And I pay my respects to elders past, future and present. You'll see that Jessie is going to share in the chat a map for the Indigenous map of Australia. If you could please say hello to your fellow colleagues and new people who you're about to meet and share which country you're from today, that would be greatly appreciated. Just before we start, typically I will go over some housekeeping. So as I said, this webinar is co-hosted between ASFI and UNGCNA. And so to ensure that everybody has a good experience, what we have done is muted everybody and we've disabled your ability to share your screen. However, we do encourage you to put on your video and talk to people and interact through the chat function. If you need any technical support, please reach out to us through the chat function, or alternatively, you can call the number on the screen. And if you have questions for our speakers, please enter those questions into the chat function that you can see down the bottom, and we'll have an opportunity to ask the questions after the discussion. So today's topic is keeping an eye on the prize. Is there still a case for divestment? And as many of us would know, the debate around divestment has changed an awful lot over the years, from whether we engage with companies and get them to change from within, or whether we divest from companies. So we've generally today, what we're going to do is we're going to hear some opening remarks from ASFI and also from RIA, so the Responsible Investment Association of Australasia. So we're joined today by Kirsty Graham, who's the Executive Officer of ASFI, and Simon O'Connor, who's the CEO of RIA. We're then going to have a discussion, a panel discussion that will include both Kirsty and Simon, and also David Jenkins, who is the Global Head of Sustainable Finance from National Australia Bank, and also Lisa McDonald, who's the Head of Responsible Investment at Aware Super. Our panel will be facilitated by Kirsty. So without further ado, and to ensure that we get the most of the hour that we've got together, I'm going to hand over to Kirsty to share any insights and reflections on the trends that she's been seeing through her work in ASFI. And once again, please enter your, or please tell us what country you're calling in from today, and enter your questions into the chat function. And we look forward to an interesting and engaging discussion. Over to you, Kirsty.
Thanks very much, Kylie. And it's great to be partnering with UNGCNA on this event and see so much interest, I guess, into digging into some of the nuance around this topic and how it's evolving and emerging over time. So for those who aren't familiar with the Australian Sustainable Finance Institute, we were established in mid-2021 to realign the Australian financial system so that more money flows to assets, projects and companies that are creating a more sustainable, resilient and inclusive Australia. And we do that by working right across the financial system with financial institutions from across superannuation, asset management, banking, insurance, financial service companies, as well as working with regulators, with government, with universities and industry organisations to drive and coordinate implementation of the Australian Sustainable Finance Roadmap. So it's this, I guess, broad financial services perspective that we bring to this discussion, and we're seeing a lot in common in terms of how investors, banks, insurers are all thinking about their role in achieving a resilient, inclusive net zero economy. And there's an increasing sophistication of thinking and a range of different tools and approaches that are being used to achieve this economy-wide transition. I think at the global level, with the establishment of the Glasgow Financial Alliance for Net Zero in the lead up to COP26 at the end of last year, that really demonstrates the commonality and mutual sort of objectives and purpose and commitment from right across the finance sector to these net zero ambitions. For those who aren't familiar with GFANZ, it brings together net zero alliances in banking, insurance, asset owners, asset managers, asset consultants, So bringing all these different financial institutions together with 130 trillion in capital under management advice to really show and demonstrate their support for accelerating the transition to net zero. So that's one example of the high-level support from the finance sector to lean in and support this economy-wide transition. And I think where investors, banks and insurers, including in the Australian market, are now is moving from that commitment to implementation. And there's a range of work happening, whether that's through collaborative initiatives like GFANs or individual financial institutions and investors doing the work around what are the right tools to use in what circumstances to achieve those economy-wide goals. The other thing just to note is that we're seeing in a range of jurisdictions, governments putting in place policies and regulations to ensure that there's adequate and rigorous information and data available to investors and financial institutions to make their investment and financing decisions in line with those commitments. And what we're seeing in many jurisdictions is there's three main pieces of this architecture. One's climate disclosure regimes, so both corporate and finance sector disclosure requirements, taxonomies that are being essentially underpinning some of those disclosure regimes and are a way to credibly measure and compare the climate impact of an asset or activity and make an assessment based on evidence about whether an asset or activity is positively supporting the climate transition required. And then the third area that we're seeing emerging in many jurisdictions is transition planning guidance and standards. In the Australian context, we've seen government commit to introducing mandatory climate reporting, which is a great first start. And with others, we're working with them on those other pieces of that architecture to ensure Australian financial institutions have got the right tools and frameworks to achieve the ambition that they have. So as you'll hear from other speakers today as well, this is a rapidly evolving area and really looking forward to hearing the different perspectives from investors, from banking, as well as from Simon's perspective and RIA membership perspective, seeing how this debate has evolved and emerged over time. As Kylie mentioned earlier, there will be a Q&A at the end, so please feel free to put your questions in the chat as we go through the discussion. And there's also the opportunity to put your hand up at the end and ask questions directly of panel members. So I'll kick off the discussion with some comments from Simon. So as the CEO of RIA, Simon, you've seen this issue evolving over a number of years. So it'd be great to get some initial thoughts from you on how you've seen the divestment versus engagement debate and practice evolve over time and what some of the most recent RIA research has to say on this topic too.
Great, thank you. Great to join you all today. So thanks for having me. I mean, this is something of an age-old debate. And I think where we're at today is we're not in an either or a divestment versus engagement. We're at a, these are, and as we started here and there is, you know, these are the multiple tools that are now available to an increasingly sophisticated segment of the investment market, operating under responsible investment practices. And so I think what's going on is we are seeing an investment market that is getting increasingly sophisticated in terms of their role in shaping a future within which they can invest and continue to deliver investment outcomes and returns for citizens who are investing their retirement savings, and wanting to take a more proactive role in terms of shaping the economy, the society and the environment within which those investee companies and assets are operating. And so there's something of an evolution going on, as was referred to. And I think it's interesting that there are a few key factors that have increased this focus on engagement as an activity and a focus of responsible investors. A few things driving this. One is we see this rise in consideration by large investors of being universal owners, of really being these large, big, long-term investors who are invested in and rely on a long-term prosperous economy upon which to deliver retirement savings for citizens. So I think that investors themselves are seeing their role quite differently as those universal owners across the economy. We're seeing this broader rise in uptake and commitment to responsible investment in all its approaches, of which divestment is one tool, engagement is one tool. And we're seeing that rise into a point where in the Aussie market, we have really around 90% of professionally managed assets now have some form of commitment to responsible investing across the market. And so are looking at the use and application of these tools. I think thirdly, though, what's really important is we're at a point in time where many of the issues we're talking about today, and we're talking about in the context of divestment and engagement, are very large, very system-wide issues to manage. Climate change transition, climate change risk being a case in point. And I guess the realisation then, as a very large long-term investor who understands the risk posed by ESG issues and who is concerned about climate change transition, there no longer is an option to divest your way out of climate change risk. And that's fundamentally, I think, shifted things, whereby this is not an issue you can avoid by making a few exclusionary decisions in your portfolio. So as a result of these factors, we're seeing investors really stepping in to say it is our role as owners and managers of capital, and the way we deploy and invest that capital, to actually be part of shaping that transition. And doing it through ownership of companies, engaging with companies, working with companies, supporting long-term strategies that are aligned with a Paris-aligned transition. That is a legitimate and increasingly used approach by responsible investors across Australia and indeed globally. So I guess, you know, we sort of talk about this in the responsible investment world as stewardship, as an approach to ownership that is acting as stewards of the capital that we're managing, or that my members are managing on behalf of citizens. And so I guess through stewardship, there are multiple tools, multiple approaches, of which engagement is one, voting is one, collaborating with other investors is really key, increasingly also advocating around policy changes, filing resolutions. These are all a suite of tools sitting under stewardship. And I think broadly, globally, and certainly in our markets, we're seeing this increasing sophistication by investors as to the use of these suite of tools. I'm here in New Zealand today, in fact, where the market is increasingly codifying stewardship. And in fact, we'll be launching a stewardship code in New Zealand in about a month's time that really codifies and lifts the sort of focus of New Zealand-based investors on the application of engagement and stewardship. So I think, in summary, there has been a big shift. Divestment, whilst traditionally would have been seen as a really important tool in the toolkit of responsible investors, is now being used alongside a number of other tools such as engagement. We can get to the question of whether there is still a use for divestment. My spoiler alert is, I think yes is the answer, but we'll come back to that, I'm sure. But these are often then used together and jointly with engagement and other practices as well. So maybe I'll pause there and get into the discussion. Thanks.
Great, thanks very much, Simon, and excellent to get that bird's eye view of how you've seen this evolving and changing, and the additional range of tools that are coming into the toolkit for investors in particular. That's also a good segue into Lisa. So Lisa, you head up the responsible investment function at Aware Super, one of Australia's largest super funds, and you've been really active and involved in the evolution of this thinking in this area. Be interested to get your perspective on how you think about divestment versus engagement when it comes to achieving the climate objectives that Aware and your members have.
Great. Thanks, Christy. And look, I just want to say, Simon, I think that was a really great introduction and setting the scene and sort of going through, there's so much in that. And if I think about Aware Super and our particular journey, particularly around climate change, we started acknowledging and recognising that climate risk was one of the real risks we had across the whole of the portfolio back in 2000, looking at ESG themes. Our strategy there, engagement, understanding the risks and the opportunities. So kind of thinking about what the transition's like, where our risks are, where the opportunities are, but engagement with the assets and the companies that we owned as an investor was a key plank of that particular strategy. Being an active owner is not new for a number of Australian asset owners. We've been a member, well, I joined Aware Super 15 years ago and we were a member of AXI, who did engagement on behalf of their members with companies on a variety of issues. So that, and divestment's not new either. So we have divested a number of industries across the portfolio, from tobacco, controversial weapons, and then back to the climate theme. When we re-looked at our climate strategy in 2019, the evolution and the pace of policy, commitments to net zero, and I guess regulation and the transition made us sort of look at, well, what does the energy transition look like, and who are the winners and losers, who can transition, who can't transition. And as investors, we need to be thinking about that, and we need to be thinking about the stranded asset risk in our portfolio, because ultimately we are stewards of our members' money, so we need to be able to invest that responsibly. The strategy from a climate perspective was rethought through in terms of what does the transition look like. And we took the view then in 2019 that thermal coal was a stranded asset risk to continue to invest in that, and we made the decision to divest from that across our portfolio. Key strategic initiative though was still around that engagement, the policy and advocacy, and being owners of the assets that we invest in, because we know we need to be able to engage with the assets that we own to be able to transition and get outcomes that are aligned to what we want to see. I think, you know, as Simon said, we need to be using all of the tools that we have in our toolkit as an owner, but being an owner and using those rights, you know, it comes with a lot of responsibility, because ultimately what we are doing is investing other money. So we need to be balancing all of that and looking at the whole of the portfolio and making those decisions. And you know, as a practitioner who lives and breathes this every day, it's not easy. And really, ultimately, at the end of the day, we are there for our members. So I think it's, you know, when you're sort of sitting back and thinking, what do I do? How do I do things? Having a really clear, I guess, strategy, implementation plan, what the stage gates kind of look like. And we talk about engagement a lot, having those escalation tactics as you're engaging. So if we're not getting the outcomes we want, what do we do? You know, at what point do we kind of go, you know what, engagement is not going to be effective. It's not going to get the change that we need in our portfolio. So therefore, when would we make that decision to divest? And we discovered, you know, that's not an easy decision for a trustee to make either. So we specifically developed an exclusion framework around that to be able to go to our board and our trustees and say, look, we have done this, this, and this. We think there's a huge risk to continue to either invest in a company or a particular sector. We need to think about that from an investment perspective. And I think having that as a tool for the board and the trustees to think through these issues has been, you know, instrumental in how we were able to sort of think about when do we divest, when do we continue to engage.
Thanks very much, Lisa, and great to hear about, I guess, the structure and rigour with which you've built up over time these frameworks to enable some of these choices of the different tools at which times. I might pass to David now, and I know that banks are also thinking through very similar issues as you both work through implementing your own climate commitments, but also work with your clients to support them to implement the climate commitments that they might have. It'd be good to get a bit more information from you, David, about how NAB and your team globally are thinking through these issues.
So as a bank, we certainly look at this as both the risk and opportunity side of the ledger. So clearly, from a risk perspective, climate risk is very much part of financial risk, and it impacts all facets of risk that the bank addresses and manages, both on our balance sheet and for our customers, whether it be from physical risk, transition risk, operational risk, market risk, across all facets. So what we're doing with our customers is taking a whole of economy approach and working under the remit or closely within the guardrails that we've signed up to under the UN's collective called Climate Action initially back in 2019, and now as we've transitioned across to the NZBA, the commitments around decarbonising our balance sheet by 2050, in line with a 1.5 degree warming scenario, setting interim targets for our main heavy emitting sectors, and as all the other banks are doing, we're working actively in the background now to publish those as part of our FY22 reporting suite later this year. And with that is upskilling bankers, upskilling, investing in resources, technology, the capabilities, testing, very much engaging with our customers, sector specialists, to enable us to both test and put in place mechanisms to actually track those commitments, how we're doing against it, because we will be required under the NZBA to then track and report on an annual basis as to how we're meeting those commitments and meeting those, tracking towards those 2030 interim targets. On a client side, there's an immense opportunity here in Australia, and I don't need to explain that, but clearly the decarbonisation trend impacts all sectors of the economy. So it has real impacts system-wide. It impacts our clients, it impacts communities, it impacts all of us, whether it be through housing, access to the electricity grid, goods and services, our supply chain. So we're looking across the entire bank at opportunities to work with our clients. I mean, many of our customers across consumer, the SME space, business, and the large end of town, to help them meet their goals. What can we do as a bank to help them accelerate that transition? And there are a number of levers that we're pulling to enable us to meet those decarbonisation goals and support customers doing that.
Great, thanks, David. We might dig into some of those things in a bit more detail a bit further along. I think something that's come through fairly strongly in all of the opening comments from all of the panelists is the economy-wide perspective, whether that's as a universal asset owner or as a very large bank who lends to a slice of the overall economy. So I'd be interested to understand, maybe starting with Lisa on this one, are there circumstances in which divestment effectively reduces those economy-wide emissions? And it sounds like you've done some thinking in terms of the overall framework. So anything else you can share on that?
Yeah, look, thanks, Christy. Look, this is what we balance up and do need to think about, because how we allocate capital and where we allocate capital and what we invest in or what we don't invest in has an impact, whether it's positive, negative, or, what we're investing in or not investing in. Is really about getting returns for our members. So, I think if everyone was to divest everything, no, it's not going to contribute to sort of real world outcomes in terms of emissions reduction. So, but as an investor and looking at how we're going to achieve returns for members, we also do believe that there is some high-emitting companies that we do not want to own in terms of their long-term value, and we're long-term investors. So I think the other work that we're doing in terms of policy and advocacy, or then engagement with the companies that we do own to reduce the emissions, is going to be effective. So we own a large portion of the economy and a large portion of different sectors. So focusing on those sectors that we think can transition, that we want to hold, that we want to continue to invest in, is where we're going to get really great outcomes and continue to be able to invest in those. And if we think about E, and there's a lot of talk about E, it's not just E that's impacted when we're thinking about climate change. It's social. We have to think about jobs. We have to think about communities, biodiversity. So wrapping up climate change as one sort of issue is just a singular issue anymore, and you can't think about it in a siloed way. So, thinking of everything and balancing it, absolutely engagement is going to be a really key tool that we have. But as I've said, we're also very focused on ensuring we're investing in long-term sustainable companies that are going to deliver returns for our members.
Great. And David, what about you from a banking perspective? How do you make some of those decisions? Or if you do choose to move out of a sector, how do you make sure you're doing that in a way that reduces economy-wide emissions?
So, as I mentioned before, we're working now to set up our sector to our decarbonisation pathways across our most high-emitting sectors, and the intention is to set those interim targets, understanding that is a portfolio-wide approach. So we began that journey by having a first cut at our finance emissions based on what we lent, using a top-down and bottom-up approach, and that was refined last year. This forward-looking decarbonisation pathway work will allow us to set targets that we will then work towards, understanding that there may be some ups and downs along that. So we have a series of climate policy changes that have been made in recent years, such as commitments to exit thermal coal by 2030, transitioning our exposure down to zero by then, with the exception of some longer rehab guarantees that are currently in place. Also exiting greenfield gas, unless in the Australian context there's a requirement for energy security, and addressing each of these customers on a case-by-case basis, how they align to our stated board-endorsed policies. Do they fit within the envelopes that we're working towards? And if not, how we can get comfort internally that the transition pathways the customers themselves have identified that they're working towards are credible, are realistic, to give us the comfort that we can then continue to lend and support them and work with them along that journey. So it's a multifaceted approach. I mean, there's the work that we're doing in terms of our own risk appetite settings. It's the advocacy work that we do with entities like yourselves, the team at RIA, many of the superannuation funds, the Council of Financial Regulators. It's working on financing solutions and developments. It's upskilling of both our bankers and our clients to understand where they can make the biggest change and where those levers are to be pulled. So it's very cliched, but it is a system-wide approach to all of this.
Excellent, thank you.
Do you mind if I add to that? Because I think it's really, you know, and I don't know what David's financed emissions are, but ours is over $150 billion in terms of everything that we're invested in. We're essentially financing, you know, all of those entities to exist. And one of the things, you know, we've set targets as well as a fund, but we've got over 100 fund managers investing our members' money on our behalf. So we need to engage with them in terms of what their climate commitments are and what they're trying to do. We own over 2,000 listed companies. That's probably 5,000. You know, what are they all doing? So going through that value chain of our investments is massive. It's taken us a year to baseline our unlisted portfolio to just try and understand what our emissions profile is. You can't set targets and you can't reduce it if you don't know what you've got as well. So, you know, the data challenges, the working with external fund managers, the process you kind of need to go to make sure we're doing this in a meaningful way that is going to get outcomes and is relevant for our portfolio is challenging, but we have to do it. You know, you've sort of got to put that in place to do it. And the more that we can engage and get companies or the assets that we're invested in to set their own emissions reduction targets that are aligned to net zero and follow through on those commitments, that's where that engagement piece is, I think, going to be really powerful for the investment community.
That's a great point, and I think a good segue to Simon to make any additions to this question, given you have members that are at varying stages of this journey. We've heard from both Lisa and David the amount of work and sort of the data availability and the strategy and a whole range of things that go into this process. Would be good to hear from you, Simon.
Yeah, there's so many interesting things coming out and good questions coming through too. So thanks for those posting them. And I think and what we're, you know, the screws are going to tighten really quickly on this, right? Because we've now got most of our major asset owners and asset managers in Australia committing to net zero. And when you start counting the years and counting the average percentage decrease in emissions in your portfolio on an annualized basis, if you start tracking that in a linear manner, which no one's going to deliver that in a linear manner, those emissions need to start reducing now. And there's going to be some easy runs on the board early. You can underweight some high emitting companies, but pretty quickly, there's going to be questions as to who's going to remain in my portfolio. And that is going to result in assets being divested of. I think what's really interesting here, though, is we, you know, if this conversation is an investor and a company kind of conversation, right, I think ultimately this is a hand-in-hand conversation about a transition, not an us versus them conversation about a transition. Like, we all are going to either win or lose if we are successful or unsuccessful at working together on this transition. So I think what you're hearing from the banks, from the super funds, and to the companies out there is that we need to work together and back the transition strategies that are aligned with that 2050 net zero target. And so I think that's where engagement is going to be such a strong part of that, and that ability for us to work collaboratively together to plot out that transition pathway is kind of key. But we're already seeing, like in the public realms, announcements by different funds choosing different ways of delivering those emissions reductions. So there are multiple options open to a Lisa of the world. as to how that transition pathway could look. And if you compare some of our major funds, there are some the other day that just announced a wholesale divestment of certain fossil fuel sectors. Others that will choose to focus on a particular asset class, property, for example, as a first kind of steps. Others that will look at their international equities and do some underweighting, etc., and reduce exposures. So there's lots of ways. I think one of the questions kind of asked about, the use of divestment. There's also lots of different beneficiaries we're working for. Lisa's members versus, a faith-based funds members versus an ethical funds members are all going to want a different approach to this. And that's where I think there's total appropriateness in divestment in alignment with the values or the beliefs or the makeup of your beneficiary group is going to look different and going to inform this too, as well as the challenges someone rightly pointed out in the chat, balancing that with your fiduciary duty. Ultimately that's the big one that Lisa, and her team have to be managing every day. And we know how hard that is. And we know what's going on with markets and the sort of energy price crunches going on right now. So this is all really hard, but I think importantly, this is an us and you working on this transition, not an us versus you. And I think that whole tone will shift. Just a final brief point, sorry, so I don't talk too much. What we're also seeing as well is engagement can occur even if you're not an owner of a company. And that's something else we're seeing increasing these, a fund may choose to divest of a stock, but may still want to engage with that company and say, I would like to invest in you in the future, but I can't right now because of what you have in place. So can we work with you to get a more credible transition pathway, et cetera? And once that's back in place, we will reinvest in you. So we're seeing that as a kind of a bit of a newer approach too, where investors will engage with companies they don't currently own. So just an additional thought. So thanks.
Excellent. Just one thing that has come up, one of the questions in the chat, Simon, that asking about, are you seeing any investors thinking about who they're divesting to? Is that something that you're seeing being considered?
I was hoping you'd handle that to someone else to answer, but I think it's a great question and a really challenging one. Like there's a responsibility even in the disposal of assets. I think there's the implication there. And I think in a listed equities context, it's really not something you can really have an influence of. Maybe there's something different in other asset classes. Lisa, I don't know if you would add to anything on that one.
Yeah, so I guess with our thermal coal exclusion, we were fortunate in that the holdings that we had were in our listed equity portfolio. So that is, we sell our shares and people buy and sell shares every day, and you don't necessarily know who the buyer is on the other side. So look, we've seen it play out with a number of companies trying to sell some of their coal assets and not being able to. So they're then, left with them in terms of having to remediate and close down the asset. So I guess it also comes to a point of, will there actually be any buyers out there that are willing to take some of these assets, knowing what may be involved and the cost involved. So we haven't had to go through that. Who are we going to sell this coal mine to? Because all of our exposure was in the listed market space. But, it's a really interesting question, because even with the listed companies that we have selling off some of their particular assets, will end up in private equity portfolios where it may not be as transparent, or you may not be getting as much information. So that there is challenges around that. So I can only sort of say, if it does end up in the hands of private equity, or it ends up in a different sort of sector, engagement is just as important in every sector as it is in the listed equities market. So broadening out that engagement, understanding what you have in your portfolio, because until these assets are wound down and closed, they're going to be owned by somebody.
Did you want to jump in on that, David? Or?
Simon touched on this earlier. We're already seeing it's such a fast-moving space. The landscape is shifting so rapidly. You look at what's happened in recent months, recent weeks, with announcements to wind down investment plans in new coal, new thermal coal, and coal mines, clearly no longer considered economic. The hastening of shutting down of thermal coal powered generation facilities. Again, these are all customers that we would bank that own them. The economics are rapidly shifting. The cost competitiveness, the investment in the policy certainty that's now coming with the investment in the transmission network and the grid infrastructure in Australia is all picking up at speed. So well, I'm not stepping away from the question, but we're seeing it changing in real time. It seems like every day you pick up and there's a new headline, another entity that's making a bet and reallocating capital. So that capital reallocation is happening every day in different ways. And we also, as a banker, are assessing these opportunities, and it's no surprise that certain sectors are struggling to get finance from the larger Australian banks, because we are looking. Climate risk is fundamental to what we do, and enabling us to capture opportunities in our growth plans in line with our broader strategic commitments. It's imperative that we make long-term bets. We don't just take a short-term view and look to, how would you say, sweat some of these assets that have a short-term time frame and are probably extremely attractive now, but it's a sum of the parts. So case by case, very difficult to make a blanket statement on this.
Yeah, no, absolutely. And that's some of the complexity and nuance around this topic that we were keen to sort of dive into in this discussion. We might just change gears slightly, and we've talked a lot about the big end of town, large companies, large assets, high emissions intensive industries, but would be interested to hear your perspectives on how some of these approaches might apply to smaller companies, investors with much smaller pools of assets, financial planners, for example, as an industry. I might start with you, David, and you've talked a bit about how the bank is supporting different clients on their net zero transition journey. I'd be interested in particularly how you're doing that through the business.
So I guess at the smaller end of town, as you'd appreciate, where I guess we are Australia's biggest agricultural bank lender. So there's a key opportunity for us to support those customers, and the team within the business bank are doing great work and investing in and working on a number of pilot programs, supporting customers that are developing technology, looking at ways where we can develop our own capabilities internally, but also adjacent to that, expand our core product offering so that it addresses and incentivizes customers to invest in equipment, technology, techniques, and that improves the ongoing climate and sustainability profile of their assets to make them a better credit risk for us as a bank and as a lender. Examples of those are we now have a green agri loan in the agricultural sector that we are working with our customers to actually roll out at scale to enable customers to get access to potentially discounted funding, to invest in sustainable forms of agriculture, to invest in energy efficiency, to invest in small-scale solar. And that's just one example. There's work underway within the consumer division to look at opportunities to adapt existing products to incentivize the move towards more sustainable housing. As the building codes in Australia are being enhanced over time, it's a huge opportunity is as every sector electrifies, how do we support customers to do that and to do that quicker? So it could be by working with some of our non-bank financial institution customers that have offerings that currently they offer at scale through lease and loan products. We, at the bigger end of the bank, provide warehouse financing as one example there. How can we share some of those learnings and opportunities to take them to term funding markets in green asset-backed securitization is just one example. These are all areas where there's deep and growing investor demand, but we need to build the capabilities here on our side and work with customers to help them along that journey. So many of them are, at the moment, they see the opportunity, and I'm sure many of you on this call would be approached every other day, it seems, with an idea that someone's convinced is the best thing. No one else has thought of it. At the end of the day, we are a bank and we're not a private equity or venture capital fund. So we are making limited bets in that space through different arms of the bank, but we are a bank lender. So we work with clients and it's a whole of bank approach, how we assess the credit risk, the impacts and the opportunities. And each of the bankers are being upskilled and taking on a broader approach to ensure that's happening.
Great, thank you. I might go to Simon because I know RIA has a large number of financial planning members as well. How are you seeing these types of issues play out with that sector of your membership?
Yeah, it's really interesting. What comes to mind, I guess, is in this space, you know, a bigger investor can often be assumed to have a louder voice, but what we're seeing increasingly is many small investors are actually being heard and having quite a loud voice, and you don't necessarily have to be a behemoth the size of Lisa's fund and to have quite a big impact. And so a few examples of that, I guess, is you know, a lot of the shareholder resolutions being put forward in the Aussie market are coming from a cohort of retail investors who own shares and who are in combination filing resolutions, and that's been brought together sometimes by financial advisors who are assisting that. We're seeing a number of the wealth management practices think about how they can engage their private wealth clients through giving them the ability to vote on resolutions, for example, and thinking about how do they convene engagement on behalf of that, which is quite novel, I think. But I think you can have quite a loud voice as a small investor. I think, you know, from a retail investor perspective, I would still say that largely this part of the discussion is pretty invisible, is not well understood. You know, when we talk to journos or consumers, there's not a great understanding of the power of ownership as a way to influence corporate behavior. And I think we need to get better at that as an industry, because I think we're seeing a lot of very strong outcomes and activity from this segment. I would also just say, you know, some of the most impactful engagement that's occurred in recent years has come from pretty small investors, to be honest. If you look at the case study of the engine #1 hedge fund putting forward, you know, new directors for Exxon and replacing 3 of the directors of the board there, driven by a very small a fund that had a very small shareholding of a huge company, but managed to drive a very effective campaign to get large institutional support there. I think is a really great case study. And I note one of the questions there about sort of what does forceful engagement look like? You know, what is stepping up? And that escalation process that Lisa referred to. And I think these are examples of stronger, more forceful engagement. And I think as investors move forward on their own net zero plans and their own transition plans, if there is not an adequate response by companies, I think you will see this escalation in engagement activities. And that might result in filing resolutions, voting against boards on certain resolutions, changing directors. So there's a lot of sort of tools up the sleeve of investors as to how to sort of accelerate that level of engagement. And I think we will see, as time ticks on and we're getting closer to 2050 and it's getting harder to meet those transition plans, you will see this escalation and more forceful engagement. And I think, you know, even the example recently of the AGL sort of ownership challenge was, I guess, an example to another question there of trying to actually take over big dirty assets, big polluting assets that and help to work with them to actually shift that, retire, transition, build a renewable energy strategy off the back of that. So I think this is a live conversation, one that's really going to be quite interesting over the coming 5 to 20 years, effectively, I think.
Yeah, what about Lisa, from your perspective? I know Aware also has sort of a financial planning arm, but it'd be good to get your reflections on how other smaller investors are also playing into this space.
Yeah, thanks, and sort of echo a lot of the comments already. I think, you know, we're seeing a lot of interest, you know, whether it's in how members, consumers want to invest and have their super invested in line with what they sort of believe in. So, and their values, and, you know, they don't want fossil fuel exposure, etc. We have seen, though, there's a real, and I work a lot with our financial planning business, because there's a lack of knowledge, even within sort of financial planners, in understanding the nuances of what does, you know, what should I be invested in, what isn't, you know, essentially what would I exclude or not be in an option or in a product if I don't want fossil fuels, etc. So that whole education piece with the financial planning industry, in terms of them being able to recommend to their clients what they should or shouldn't invest in, is a whole other sort of, you know, panel or session. But it's really important because it is misunderstood. A lot of people don't know. A lot of people go, oh, I don't want to invest in this. When you sort of take them through a risk return profile and, you know, what does this look like and what are you actually trying to achieve, there's education required across the board, sort of in the financial planning arm. We know that the smaller end of town, even in ASX sort of 300, they're struggling with a lot of the how do I think about ESG issues, my strategy and my company. company, and how do I do this? What does it look like? So don't let size get in the way of what needs to be done. I think the smaller, whether you're a smaller company or a small investor, collaborate. Utilize the memberships of the organisations that you have or are a part of. So, ASFI, RIA, PRI, AXI, IGCC. There's a number of ways you can engage, collaborate, and invest by utilising the networks that you might have and leveraging those, because not everyone has large teams, not everyone has all of the knowledge, and so you need to be able to sort of join and partner with those organisations that are going to help you. Engagement takes a lot of time and a lot of resources. There's a lot of research that needs to be done before you walk into a company and try to engage a company to get the outcome and the change that's needed. But and I think we will see, we've updated our sort of engagement and voting policy and guidelines, that if we're not seeing companies move, we will vote against directors. We will, vote against, and I think what might be next is remuneration plans and outcomes. So, being able to use all of those particular tools. We know companies don't like to not have their directors elected, their remuneration plans approved. So it's a pretty powerful tool that we've got if our engagement isn't working.
Thank you. That's very useful insights into a bit deeper on the engagement side, and picks up on one of the questions that was asked in the chat, which is about how you set targets for engagement. I don't know if that's something that you want to say any more on.
Yeah, and look, I think it's really important. So engagement's not new, right? So we have been engaging with particularly the listed companies that we've invested in for 15 years. I've been with Aware Super, as I said at the start. I think what's becoming more and more important, though, is how we're transparent on that engagement. And everyone wants to know who you're engaging with and what you're doing and what you're asking for. So it's that balance of being able to have a really, really robust discussion with a company that are invested in the outcomes we're looking for. So yes, we do have, for the key engagement themes and companies we're engaging with, we have outcomes we're looking to achieve. We track those. A good example might be where we've asked the ASX 200 to set net zero commitments. And to put a policy in place. So we'll track how many of those have it, engage with the ones that have it, focus and continue to engage with those. I think what the evolution is being transparent and reporting that to our stakeholders and to our members in terms of who we are engaging with, what we are asking for, and where we are at on those outcomes. So we started last year with the stewardship report in trying to, communicate and be transparent in terms of what we are engaging on, and that can evolve. And I think the whole industry can evolve in terms of what that looks like and being more transparent on that side. But if you don't have a target or an outcome in mind, I'd questions of what your engagement program is aiming to achieve.
Excellent. And I think that links to a couple of the other questions that have been put through the chat as well. And feel free, anyone else who's got questions, to please keep entering those in. But there's a question around, would a tool to measure sustainability credentials be helpful? And then a later one about the S considerations in the climate transition plans. And I think this speaks to, the broader tools and frameworks and, policy and regulation that's required for all of these efforts to be effective and be clear that they're achieving kind of the economy-wide objectives that we have. I don't know if you want to jump in on that first, Simon, and then I can pass to others as well.
Yeah. Look, I think this is, if we want to measure whether we're achieving the objectives we've set ourselves, we're going to need to be able to track the data to understand how we're tracking and the trajectory there. And so hence there are lots of sort of building block pieces coming into force now that will help that, and things such as TCFD disclosures become really important for an investor to manage that aggregate climate risk exposure through their portfolios. Things such as consistent and comparable sustainability disclosures more broadly is really important and will come into force soon under the ISSB disclosure frameworks and standards. And taxonomies will be really important in the ability to objectively classify a green economic activity versus a dirty economic activity, or however those are defined. And so I think all of these are really important pieces that will allow us to measure much more accurately whether the sustainability credentials, as that question has sort of put it. So I think that'll help. I think a lot of those frameworks and building blocks are coming together right now, which is great because it's been a long time operate in the absence of them, and they will help a lot in terms of underpinning our ability to track and measure really objectively. So yes, that will be helpful.
David or Lisa, do you want to jump in?
Is there a particular angle or particular?
So from a banking perspective, do you see that harmonisation of tools, frameworks and approaches being useful, I guess?
Oh, definitely. So to Simon's point, the development of the ISSB and the impacts and global baseline and comparability is fundamental for both banks in terms of our reporting, but also our larger customers that are looking to access capital on the global stage. I mean, they need to be compared against their peers, because investors, and I'm sure Lisa can talk to this, are making capital allocation decisions on a global basis, not just limited to Australia. But the other component of that is there's clearly a need to ensure that whatever is forthcoming reflects different starting point in Australia. So it's always very difficult to say we simply adapt what's being done in Europe with the EU taxonomy and many of the regimes and reporting requirements coming out of Europe, and just simply plug it into Australia. It doesn't necessarily fit like for like, and we've seen some of the challenges on the social dimension, as you can see with what's happened in Europe with the decision to delay the development of their social taxonomy. It's just one example. It's a very, very big challenge to find the right metrics, but the ISSB is a great step towards that. The topic of ESG risk ratings is another whole can of worms as well, because that's very topical. Regulators are looking at that across the board, given the different approaches and arguable correlation across them at different places, but they all add value. But they're part of the toolkit, and I don't think we could jump to one in isolation. We need to find what's best and ensure that there's comparability for both our borrowing customers, our business customers, as well as investor customers.
And there's a related question to that that Jenny has put in, which is, are you measuring how are you measuring impact, or how are you measuring portfolio alignment? Is it percentage of revenue from green or sustainable activities, or additional capacity? And I think that goes to what taxonomies are designed to do, is to really credibly kind of measure the impact that an asset or an activity is having, whether on climate, biodiversity, other sustainability areas, rather as well as mapping that impact to portion of revenue of companies.
So, I mean, at an enterprise-wide level, I mean, the bank has been reporting under the GRI standard for a number of years, and with the, I guess, partnership of GRI and SASB and the evolution of the ISSB, we expect that over time we'll transition to those new standards as and when they come out. But it is happening in real time. There's a myriad of reporting that's underway within the organisation to both ensure we produce what we're required to do for our financial accounts, for our annual reporting suite, but also to measure and track how we're progressing towards the various commitments we've made, such as exiting particular sectors, reducing our balance sheet exposure to thermal coal and other sectors as one, how we're tracking towards our commitment around environmentally focused financing that we made a number of years ago. I think you'll see more evolutions of those around both dollar and impact. And then as we, from a bank funder, as we access public capital markets, we have an active green bond issuance program where we outline the impact metrics that we will be reporting on. And it's the obvious ones are avoided greenhouse gas emissions. Depending on the sector, the metrics may be slightly different, but that's the obvious one. If you look at some of the other nuanced areas, it could be the line, the number of vehicles financed, the amount of modal shift, the number of passengers that have transitioned out of fossil fuel or ICE vehicles into public electrified transport, things of that nature. So it is far-reaching, and I'd suggest a good example is to look at how each bank reports impact and use of proceeds for the various green and sustainable financing programs. That'll give you a good feel as to where the bank is lending and the real impact of those. But going forward, it'll be far more detailed as we transitioned onto ISSB.
Excellent. So there's a couple of questions related to coal, which I'll wrap up into one and might pass to you first, Simon. So the first one is, given the divestment and the impact that divestment around tobacco has been highly successful, but tobacco stocks are still very lucrative. The question is, how long do you foresee divestment in thermal coal having an impact on the closure of plants and mines and a commitment not to mine new greenfield sites? And then wrapping in another question is there likely to be a difference between metallurgical and thermal coal?
So on question 2 first, yes, I think most investors are really distinguishing between met coal and thermal coal. And I think we're seeing that in terms of the specific commitments to divestment usually start with the thermal coal, which has substitutes, and met coal, which has less immediate substitutes in terms of the steelmaking process. So that's a critical distinction. I think fundamentally to part 1 of that is capital is shifting away from the dirtiest of assets and towards the cleaner assets. And that is going to start from the dirtiest of assets, and that is going to accelerate, making certain things, as David's indicated, finding it harder to raise capital for certain assets. And we're going to see that as sort of a hierarchy, and greenfield thermal coal, you'd hope, will be the top of that hierarchy. It'll be the hardest to get capital in the nearest term. And then we'll start going down that hierarchy in terms of dirtiest assets. And so I think we will get to a point where when norms have effectively shifted such that greenfield thermal coal is just not an acceptable kind of investment when you're managing money on behalf of the average Australian, in light of having national Paris ratification, etc., in place. So I think, yes, in the manner of tobacco, we'll see similar kind of shifting norms such that it's a common universal exclusion. It's just out, and then we'll start going down through those assets from dirtiest to cleanest. I think that will continue. And as we said earlier, as the screws tighten on the net zero commitments, those decisions are forced upon investors effectively, in a sense, and we'll start seeing that changing.
David or Lisa, anything else to add on that, or a final word before we wrap up?
On the metallurgical coal, to Simon's point, at the moment, there's no stop and move to a feasible alternative right now. So we're continuing to support customers at this point, but we're treating each transaction on a case by case, and there is enhanced ESG due diligence as part of the lending process underway. But clearly, over time, as with technology advances and the increasing cost competitiveness of some of the green steelmaking processes, we expect you'll see a transition away from metallurgical coal. So that's the first element. I guess on the other piece, the thermal coal element, as I've said before, we continue to work within our current policy settings. We're well on the journey and ahead of where we plan to be, which I believe was reducing our exposure to no more than 50% of where we were by 26. We're well on that path, and then completely exiting by 2030. So we'll continue to work on that basis. And as Simon says, the cost of financing those projects continues to increase, and it's easily observable, albeit the energy crisis and the Ukraine crisis are making things challenging right now, because there's a clear need for energy security globally at the moment, which is driving demand.
Thank you. And that's been an incredibly rich, engaging discussion that has had really great participation and engagement from the audience as well. So thank you, everyone, for being so active in the chat. I'll pass back to Kylie to wrap up the session.
Thanks, everybody. And thank you to those who have stayed on the webinar until the end. I know that we've eaten into some people's lunch times. I just want to thank Christy, David, Lisa, and Simon. That was such an informative panel. I really enjoyed it. I will apologise to those people whose questions we couldn't get to, but obviously we could talk about this for hours. So I suggest that everyone keep reaching out, have those engaging conversations. I know that people are probably surveyed out, but please do fill in our survey. The QR code is on the screen and the link is in the chat box. This will really help us to inform future webinars and webinars that we can do with ASFI or any other organisation, RIA, etc. We'd really love to hear your views so that we can share that with Christy and her team as well. So thank you again for a really engaging topic. I hope you all enjoyed today's webinar. It will be available publicly soon, so we will send around the link to that as well. And we hope you enjoy the rest of your day. Thank you very much for joining us, everyone. See you next time. Bye.